Hello everyone, I am Faiz Amir, one of the Vestigos' managing partners. Today we will talk about our view on how to scale up a startup. And before we start, I would like to point out that there might be many approaches to scale up a business. What we recommend here is one way to get it done successfully. Let's look at the agenda. We will start with our startup roadmap, talk about the readiness, and then some strategy brainstorming. Finally, we will close with risks and a case study. In the next slide, we will talk about our startup roadmap, which shows the different stages that a startup usually goes through. We use this roadmap to define the stage of each startup. Most startups usually follow these 4 steps at a high level. The stages are not constrained by time, so please don't assume that each stage takes equal time. The formation stage, at the top left side, is where the entrepreneur sets the basics of the startup, such as formulating the idea, finding co-founders, brainstorming the first few steps, like who the clients are, why this market, what product and service, when to address the market, and so on. Then, assuming that the startup has evolved, the validation stage is when there is an MVP. We have some pilots and some initial traction. The third stage is what we will cover in more detail in this presentation. The last stage of the journey is the exit for a few startups that will manage to achieve it. For most entrepreneurs, the journey is rarely a straight line. There are surprises along the way. Times when you are unsure about the next steps or you go back and forth. That's all natural, and it happens to most entrepreneurs. So an entrepreneur needs to remain focused on target, but adaptable and not get discouraged. Remaining patient and committed are amongst the key success factors. Now, looking below the green line, you will see that each stage has a milestone, such as problem-solution fit or market fit, which is extremely important for every startup. Again, this may be different from startup to startup. Finally, on this roadmap, there is more info about each stage and step. For this pitch, I'm going to focus on scaling only. When a startup is ready to scale up is a good problem to have, because it means that you have achieved major milestones before, such as robust cash flow, you have a viable and scalable business model, and all the right ingredients to move forward successfully. It also means that you need to plan it carefully. According to Startup Genome, nearly 75% of startups fail when they try to scale up. At the bottom of the slide, you will also see various funding rounds that usually accompany the various stages. Usually, when we talk about scaling up, a company either plans to raise or has raised a Series B type of funding round. Let's talk about readiness. And probably the first question that an external observer would ask every startup is, are you ready to scale up? Usually, the startups scale up when they want to enter new markets and have already experienced high growth. So here are a few ideas about how to answer that question. Starting with, is your business model viable for scaling? For some startups, that may mean that they can introduce new revenue streams fairly easy, or increase their margin, or gain more market share. Can your business be replicated with the same success into another market? Not every market is the same. There are examples of big brands which tried to enter new markets, and they didn't experience the same successes as elsewhere. For example, Best Buy, which is a huge player in the US, failed in Europe due to poor marketing strategy and the fact that Europeans prefer smaller shops instead of large. Another example is Halo, a UK-based taxi finding app that raised over $100 million funding but failed when it tried to expand into the US. It became the victim of the price war between Uber and Lyft. Next, is it the right time? That's a very important decision-making point. The right time plays a crucial role to success. If we take, for example, the coronavirus epidemic, it would be risky to scale up a hospitality or tourism startup before the dust settles. Then, can you achieve sustainable growth? You have had some great achievements so far and have generated revenue, But the business world is very fast moving. New competitors appear all the time. Trends come and go. Initial success cannot guarantee continuous success. Finally, is your cash flow robust? That's another key element that you need to think of before you decide to scale up. Would you need funding? That's quite common for companies with high growth potential to request funding at this stage. In most cases, they would have had existing investors, or their achievements and financials would create an attractive funding proposal for VCs, family offices, angel investors, and so on. This slide talks about strategic brainstorming. As mentioned before, startups usually scale up when they want to enter new markets or expand the team. Here are just a few examples, like improving customer service and quality. Both are fundamental to increase customer loyalty. You may want to invest more on technology. As you grow, you will need additional tools to support your growth. Expansion can either be vertical or horizontal, or both at the same time. One of our clients, for example, has created a plugin for software for AutoCAD, a software that is very popular amongst engineers. Their product enriches the AutoCAD experience with almost real-time images from a construction site or a building development. The engineers use these images to assist their planning or view updates on a construction site. This company has been around for more than 5 years with solid financials, traction, and profitability. Now, they want to scale up vertically by adding a lot more functionality to the current software, and also horizontally by entering new markets that their solutions may add value. During the expansion, they will form a strategic partnership with vendors. Finally, it may be people. Customer service is one area that you need more hands-on to handle customer requests and maintain high-quality standards, or you may need to bring development in-house. A lot of startups start with outsourcing their development due to cost, and later on they bring it in-house for better control. For tech startups, it might be the opposite. They might want to bring marketing in-house, for example. Moving to the strategy now, which is the center of this exercise. Let's say that you have decided to enter 3 new markets. Our approach tackles the scaling up from 5 angles: people, technology, processes, culture, and change. As mentioned before, there is not one-size-fits-all solution, so this approach could be customized based on each company's needs. People is the most important asset of every company. In most cases, startups will definitely need to hire new talent as they grow. They may also have to adjust or change roles as their needs change. They might need to train people and equip them with new skills. At this point, it's also important to assess management's capability. Maybe your board or executives needs to have a different skill set to take you forward. There are examples where the co-founders had to step back and allow others with specific expertise and knowledge from the industry to replace them. Technology is also very important. As the company grows, you would need more technology to increase efficiency and productivity. For example, you may need an ERP or a CRM tool like Salesforce or Zoho, Intercom for customer service, or Slack, Jira for organizing teams and running projects online. You may need to invest more on your technology to make it even more scalable or resilient. Protecting your data is always important at all stages. For regulated companies or startups, serving their regulated clients is a must from day one. For non-regulated, maybe now is the time to address your security. You need the right strategy around protecting your application, endpoints, and sensitive customer data. During the early stage startup, a lot of processes happen manually due to shortage of resources. That's all natural for most startups. As a company grows, however, you will have to focus on standardizing, optimizing, and digitizing processes, even for non-core, because manual processes will harm productivity in the long term. Maybe you need to set up operations to tackle daily issues in a more structured and measurable way. Imagine your company growing from 30 people to 150 people over the next 18 to 24 months. You may then need to standardize the HR employee entry and exit process or set up around-the-clock customer service. Culture also plays a role as the company scales up. This is probably the time where a startup begins to embed corporate practices. This does not mean that you will stop being agile, dynamic, and fast-paced, or you would lose your startup mindset. But leveraging the best corporate practices where applicable and necessary will bring a more structured and measurable way to run this. Finally, it's change. Change is inevitable and will happen many times, especially in a fast-paced environment like a startup. Now that the scale-up is planned, things will change. For example, people may change roles or new people will come on board. New tools and processes are. So, planning the change management to fit the new vision or the new strategy is important. You may need to do a stakeholder analysis or the communication strategy has to be adjusted. For any new situation taking place into an environment, a transition exercise has to be planned and executed carefully. To summarize this slide, we approach the scaling up exercise from 5 angles: people, technology, processes, culture, and change. The approach needs to be adjusted on each individual startup's needs and priorities. As mentioned before, scaling up a startup has risks that may kill a business. The first risk is the premature scaling up. Almost 75% startups fail due to premature scaling up. This can happen because the timing was not right or the prerequisites we discussed before were not in place. Even if the premature scale-up does not kill your business, it may impact your growth. A slow growth in a fast-paced environment can be very harmful. New competitors may appear, it may impact your cash flow or your ability to raise further funds quickly. Poorly planned scaling up happens when you haven't thought all the dimensions. For example, your technology has not been adjusted according to the new market that you aim to address, or the expected customer experience is different. Your customer service remains centralized, which means it can't meet the local needs in terms of availability or language. Your team size and capabilities remain the same, and now they're maxed out with additional work and can't support the expansion maintaining quality. These are all important considerations to take into account when you plan a scaling up activity. Let's see this case study from Sukal Mal, which is a success story so far. So Sukal Mal started in 2012 as personal finance aggregator. A few years later, they decided to add another vertical on insurance. They succeeded into scaling up the business by growing the insurance vertical with an astonishing rate of 800% plus. Sukal Mal also dropped the customer acquisition cost by 80%, raised more funding and added new verticals. Summarizing what we have covered so far and few closing thoughts. Start by identifying where you stand on the roadmap. At what stage is your startup today? In terms of scaling up, are you ready to scale up? Is this the right time to do it? Brainstorm before acting. What are your priorities? What does it make sense to do first and what later? Consider the 5 angles: people, technology, processes, culture, and change while you plan and execute your strategy. Proper planning is extremely important. Learn from successful examples. What did they do right? Many thanks for listening to this presentation. Feel free to reach out for further information by dropping us an email on info@vestigos.com. That's info@vestigos.com. Thank you and goodbye.